Welcome to the deep dive. If you've glanced at today's financial headlines, you'll know it's been, well, quite a whirlwind.
Yeah, a real mix. Political drama, market jitters, economic uncertainty, all over the place, really.
Exactly. It's enough to make anyone feel a bit lost in the noise.
For sure.
So let's try and cut through it.
Yeah.
Today, we're doing a deep dive into some truly significant global economic and financial events that unfolded, well, basically today.
All right.
Our mission for you is to unpack a major political move in the U.S., explore its ripple effects across European markets, and really connect the dots. See why these things that seem separate are actually, tightly interwoven.
Right. It's not just what happened, but the why behind it.
Precisely. Why it matters for the global economy and for your own understanding of how markets tick. And honestly, you might be surprised how a decision in the U.S. can affect something like chocolate prices in the U.K.
It's a fascinating and sometimes unnerving interconnectedness we see these days. A tremor in one place sends waves everywhere else. Yeah. It's like today's news isn't just headlines. It's a real-time lesson in that.
Couldn't agree more.
Okay, so let's jump right in. The epicenter seems to be the U.S. today. We're talking about a really unprecedented move by Donald Trump, launching a direct attack on the American Central Bank, the Fed, specifically targeting Governor Lisa Cook for removal. What makes this so, well, extraordinary?
Well, it's the sheer directness of it.
Yeah.
Trump put out a letter, on Truth Social no less, claiming sufficient cause to fire her.
Based on what exactly?
Allegations about false statements on mortgage loans. I mean, this isn't just, criticizing Fed policy. This is an actual attempt to oust a sitting governor. We just haven't seen this kind of thing from a president.
Wow. And Governor Cook's reaction, how's she responding to these, very serious allegations?
She's hit back quite forcefully, stated very clearly that Trump has no authority to fire her, and she's definitely not resigning.
She emphasized she's committed to addressing any questions, gathering the facts. And, it's worth remembering her historical position, the first Black woman on the Fed board. That adds another layer here.
So this isn't just political noise, then. It feels like a fundamental challenge to how the U.S. economy is supposed to work. Why is the Fed's independence such a big deal?
It really is the bedrock. The Fed's independence allows it, theoretically anyway, to make monetary policy decisions based purely on economics, not political wins.
Right.
It's the central bank for the world's biggest economy, so its credibility is paramount. Any sign that independence is eroding, well, that creates huge uncertainty. Markets hate uncertainty.
They certainly do.
Traders start wondering, are future decisions going to be about the economy or about politics?
And the markets definitely picked up on that uncertainty straight away.
Yeah.
What were the immediate signals? How did they react?
Oh, it was a classic risk-off move, almost immediately. The U.S. dollar index, it slipped 0.1%.
Okay, weakening dollar.
Yep. Long-dated Treasuries actually dropped in price, meaning their yields went up. But then you saw gold, the classic safe haven, jump a full 1%. And futures on the S&P 500 and NASDAQ were down modestly. So just a general sense of caution spreading.
You also mentioned this sizable steepening of the Treasury curve. Can you unpack that a bit? What does that actually mean, and why is it significant?
Sure. So what happened was the yield on the 2-year Treasury short-term debt actually went down slightly by 0.7 basis points.
Okay.
But at the same time, the 10-year yield went up 2.9 basis points, and the 30-year climbed even more, 4.5 basis points, hitting 4.93%.
Right, so short rates down, long rates up.
Exactly. That difference between the short-term and long-term rates, what we call the 230 slope, widened out to 122 basis points. That's the steepest it's been since January 2022, before the Fed started hiking rates post-COVID.
And what does that steepening tell us?
Well, it suggests a couple of things, potentially. Markets might be thinking, okay, maybe this chaos means a short-term rate cut is more likely.
The sugar hit idea.
Exactly. But at the same time, they're getting more worried about the long-term, maybe higher inflation down the road, or more government borrowing because of political instability, or maybe concerns that a less independent Fed won't fight inflation as hard. It's complicated.
That tension, short-term gain versus long-term pain, is really interesting. Tony Sycamore from IG had some thoughts on this, right? How do investors juggle those?
Yeah, Sycamore laid it out quite well. Short term, he said, Cook's removal, given she usually voted with the majority, could make a September rate cut more likely.
Which markets generally like.
Right. That's the sugar hit. It could weigh on the dollar, maybe boost stocks, Bitcoin, other risk assets. And the market's definitely leaning that way, pricing in an 82% chance of a September cut right now.
That's high. But what's the downside? The long-term risk.
Well, beyond that potential bounce, Sycamore warns this whole thing seriously increases worries about political interference.
The Fed being seen as compromised.
Exactly. If traders start really believing the Fed isn't independent anymore, that could trigger a sell U.S. assets move. We could see sharp falls in both the dollar and U.S. stocks.
How would we see that playing out? What are the warning signs?
You'd likely see it first in bond yields, investors demanding a bigger premium to hold long-term U.S. debt. Then a more sustained slide in the dollar, signaling, a loss of global trust.
And Deutsche Bank economists were talking about a potential dovish majority on the Fed board itself.
Yeah, they pointed out that if Cook is actually dismissed, Trump could fill another vacant seat.
Right, there are vacancies.
And with Stephen Mirren already nominated for one, plus you've got Governors Waller and Bowman who already dissented, wanting a rate cut back in July. Well, you could end up with a majority on the board pushing for lower rates, perhaps sooner than the economic data alone would justify.
It really feels like these political moves could ripple out for a long time. What else should we be watching, besides the politics?
Definitely keep an eye on the upcoming U.S. economic data. Durable goods orders, Case-Shiller, house prices, consumer confidence.
Usual fundamentals still matter.
They absolutely do. They could either reinforce or push back against this market expectation of a September cut. And just to underline how serious this is, Professor Justin Wolfers compared this situation to Turkey under Erdogan.
Wow, that's a strong comparison.
It is. Erdogan's interference with Turkey's central bank caused massive economic instability. It's a cautionary tale, for sure.
Definitely unsettling. Okay, so these tremors started in Washington, but they didn't stay there. They spread across the Atlantic pretty quickly. What was the immediate reaction in European markets?
Yeah, the caution spread fast. European stock markets opened lower pretty much across the board. The main stock 600 index was down 0.7% early on, just investors pulling back.
And some specific markets got hit harder.
Absolutely. France's CAC 40 was down quite sharply, 1.4%. The UK's FTSE 100 fell 0.6%. Germany's DAX was off 0.9%. Italy's FTSE MIB down 1.2%. So yeah, it was widespread nervousness.
France seems particularly shaky right now, politically and economically. Prime Minister Bayrou calling a confidence vote. What's the outlook there?
It looks very difficult for him. He's called this vote for next month, ostensibly to get backing for budget measures.
But does he have the votes?
That's the problem. His coalition only has 210 seats out of 577. The main opposition parties, they have 264 MPs combined, and they've already said they'll vote against him.
So it hinges on
the socialists, really, but they seem unwilling to back him unless he makes major budget changes, which doesn't look likely. Charlotte de Montpellier at ING called it an almost impossible obstacle.
So if Bayrou loses, Macron's in a tough spot. What are his options? This sounds like it's hurting the economy, too.
Precisely. If Bayrou goes down, Macron either has to find a new PM who can somehow command a majority in this fragmented parliament, good luck with that, or dissolve parliament and call another election, which he said he wouldn't do.
A real dilemma.
And yes, this political mess is definitely becoming an economic liability. France's economy is already weak, expecting maybe 0.8% growth this year. This uncertainty makes drafting the 2026 budget harder, delay spending cuts, and could make France's debt situation worse.
How did markets react to that news specifically?
French government bond yields rose. The 10-year yield went up 2 basis points to 3.51%, its highest since March. Some analysts are even whispering that French yields could end up higher than Italy's if this drags on.
Okay, let's hop over the channel to the UK. Sounds like they're facing their own hard yards. What happened with their bonds, their gilts? Was that tied to the U.S. news, too?
Yeah, definitely connected. UK gilts sold off. The 2-year yield rose 6 basis points to just over 4%. The 30-year yield hit 5.634%, its highest since April.
Why the sell-off?
Partly that global reaction to the U.S. Fed news, rising U.S. yields tend to pull others up. But also domestic worries. Investors are demanding a higher return to lend to the UK government right now.
And then this talk of an IMF bailout risk. I mean, that sounds extreme. How seriously should we take that?
Well, Professor Jagjit Chadha from Cambridge used some very strong language. He said the economy's risk of collapse is as perilous as just before the 1976 IMF loan.
1976.
Wow. He's worried about the UK being able to roll over its debt and pay its bills. Now, an actual bailout might still be a way off, a worst-case thing, but the fact that respected economists are even making that comparison tells you how precarious things feel. And the pound wasn't looking too strong either, down slightly against the dollar.
And it wasn't just government finances feeling the pinch. The UK retail sector took a hit after a gloomy report from Deutsche Bank.
It did. Deutsche Bank analysts basically said the good times or the less bad times for UK consumers are over.
Sweet spot is gone.
That's their phrase. They downgraded Associated British Foods, the owner of Primark, to sell its stock, fell 5%. Wickes, the home improvement store, got downgraded to sell too, fell 9%. Kingfisher, which owns B&Q, down 4% after a downgrade to hold.
So what are these hard yards they're predicting?
They think real wage growth is going to slow down, and worries about unemployment will start to bite in the second half of this year. Their model suggests people will really cut back on discretionary spending, the non-essentials.
Ouch. And on top of that, food prices are climbing again. This is where the chocolate connection comes in, right?
Exactly. The British Retail Consortium reported shop prices rose at their fastest pace in 18 months in August. Food inflation specifically hit 4.2%.
What kind of items?
Staples like eggs and butter saw big increases in demand, supply issues, labor costs. And yes, chocolate got pricier because global cocoa prices are sky high due to bad harvests. The BRC chief, Helen Dickinson, said it's putting immense pressure on living costs.
It really paints a tough picture.
Yeah.
Were there any specific company stories reflecting this pressure?
Yeah, a few things. British American Tobacco's CFO stepped down. That always makes investors edgy. Bunzl, the distribution company, reported sales growth but lower profits, though they did restart share buybacks, which is a small sign of confidence. And Wood Group, the engineering firm, their board said it was minded to accept a lower takeover offer from Sidara. That often suggests companies are finding it harder to get the price they want in this environment.
So when you pull back and look at the whole picture, this U.S. political move, the French turmoil, the U.K. economic worries, they're all feeding into this general sense of caution, aren't they?
That's absolutely the key takeaway. It shows how interconnected everything is. Worries about central bank independence hit currencies, government instability hits bond yields, consumer spending fears hit retail stocks.
It's not just separate stories.
Not at all. They influence each other, and they collectively shape market sentiment globally. It affects everything from, big currency moves down to, yes, the price of your chocolate bar.
So for you, our listener,
Yeah.
why does digging into this level of detail actually matter?
Well, because understanding these underlying connections gives you a much richer perspective than just reading a headline, right? It helps you maybe anticipate shifts, make better sense of the news flow instead of just reacting. It's about getting that critical context to understand the forces shaping the economy around you.
Context is definitely king. And today's deep dive really highlights how fragile and interconnected global markets are to political moves and economic facts on the ground, whether it's in Washington, Paris, or London.
It really does, and it leaves us with a bit of a challenging thought, doesn't it?
Go on.
Well, with everything becoming so intertwined and politics seeming to interfere more directly in economics, what does market independence or even economic stability truly mean anymore? And how do you, as you navigate your own decisions or just try to make sense of the world, how do you even assess these kinds of evolving risks? Something to think about, I suppose.
Definitely something to chew on.
Yeah.
Thanks for joining us for this deep dive.